Welcome, ladies and gentlemen, to segment 3 of the Cima Strategic Case Study Financial Strategy or F3 Essentials Refresher. This segment is on dividend policy. Let's have a look. But before that, I have to remind you what you need to do or what you need to be prepared with. Please have a notebook and pen on the ready. Follow the slides and my explanations very carefully. Take notes and even scribble down questions. Maintain a list of doubts and clarifications. Maintain a list of key topics that you feel you're weak at so you can self-revise later, and make sure that you stay focused. On that note, I'd like to take your attention to the core activity again, and within the core activity, as you can see here, this is what we are talking about. The Cima SCS examiner expects you to be really good at recommending dividend policy, which means to recommend dividend policy, we have to, it's policy, it's not dividend strategy, it's not the dividend decision, it's dividend policy. Why policy? Because policy is stable, policy is concrete. For a company, you can't expect to really change policies on a yearly, on a monthly, or on a biannual, or very frequently. Policy is something that is static, and policy is something that investors look to rely on. It's an important idea. That is why we have to have a thorough understanding of the elements in deciding and structuring dividend policy. Okay. As far as understanding the elements of dividend policy are concerned, you have the theoretical aspect of thinking whether dividends are relevant or not, which has been proposed in detail by Modigliani and Miller. But in addition to that, we also have to think about the practical aspect, such as signaling, clientele effect, and other alternatives to paying out dividends, because those will determine the investor perspective of our company, and that can lead to how our share prices move and whether we will be able to retain investors and therefore as a result retain solid owners, because owners are important, right? If the owners are rich, all the better. So it's important to keep the owners happy, and we do that through dividend policy. One long-standing question in corporate finance is shareholders' wealth affected by a company's dividend policy? Here the question is whether the chosen policy matters, not whether the dividends matter. So policy is what is important, as I already mentioned. Now, examples of such policies may include paying a constant annual dividend, paying out a constant proportion of earnings, increasing dividends in line with the annual rate of inflation, and paying out what's left after financing all future investment. Now, we will be looking at it in detail. But before that, the key factors to consider in relation to the payment of dividends are, you can talk about Modigliani and Miller or MM's dividend irrelevancy argument, the interests of shareholders associated to the clientele effect, and the bird in the hand argument. Then the signaling effect or information content of dividends, right? What kind of signals do the dividends send out? And obviously the cash needs of the entity. Okay, so when it comes to evaluating and really thinking around establishing dividend policy, we have to try and understand various arguments, various opinions of various stakeholders and past economists. Now, one of the most prominent arguments that we have is this bird in the hand argument. This analysis puts forward a very simple argument. Some investors may find capital gains more tax efficient than dividends, right? So when the share price goes up, the gains that you make is more tax efficient because it's most likely that the tax implications to capital gains is much lesser at least in the short run to medium run than dividends. And some investors will avoid transaction costs if their returns are delivered in the form of capital gains rather than dividends. Despite all this, investors generally have a strong preference for dividends. The reason given is that a dividend is certain, and investors prefer a certain dividend now to the promise of an uncertain future dividend arising out of retaining and reinvesting earnings. So it's just this idea that it's better to have the bird in the hand rather than assuming that the bird will come to your hand at some point in the future. And that leads me to another perspective, the interests of shareholders. It is critical that a business satisfies the needs of its shareholders with its dividend policy. If the shareholders don't feel that the business's dividend policy meets their expectations, they will sell their shares, perhaps causing the share price to fall, not perhaps, almost all the time. Now, two important considerations in the context of shareholders' interests are the clientele effect and the bird in the hand argument, which we already looked at. Now, in figuring out how important shareholder interests are and understanding that shareholders prefer prefer order, right, not uncertainty, prefer certain amount of certainty, which was explained in the bird in the hand. The other aspect to this is the clientele effect. Now, in the real world, there are differential tax treatments of dividends and capital gains, and there are transaction costs on share dealings. So this differential tax treatment on dividends and the transaction costs on share dealings, these are both aspects that an investor will be sensitive to. As a result, shareholders are concerned as to how their return is delivered to them by the company. Thus, companies should follow a consistent dividend policy so as to ensure that they gather to them a clientele of shareholders who like that particular policy. So in the earlier slide, we realized that there are different ways of how dividends can be distributed. Different people will prefer different of these ways. So a company, that is why it's very risky for a company to switch around these dividend policies, because it means you will not have reliable, you will not be able to develop or accumulate a set of reliable clientele as far as shareholders are concerned. Thus, the argument here is that the actual dividend policy that a company follows is unimportant. But having decided on a particular policy, it should then keep to it. The clientele effect. That brings me to the dividend irrelevancy argument. Now, this is also interesting and it's also not that complicated. Now, MM's dividend irrelevancy theory says that the pattern of dividend payout should be irrelevant, right? That the pattern of payout is not, or dividend policy is not a very relevant aspect. This comes from the idea or argument that they say as long as companies continue to invest in positive NPV projects. So what happens is dividends are additional profits, no? Profits that you can afford to pay out, no? So another thing that you can do with these profits are to invest in positive NPV projects. So if every single project that you have to do, that you undertake, generate positive NPVs, that's probably, in their opinion, much better for shareholders than, taking it out as dividends, because in the long run, more profits mean more profit, more higher NPV is more profits, and more profits mean more return, end of the day, and more profits mean also positive outlook and therefore capital gains. So as long as companies continue to invest in positive NPV projects, the wealth of the shareholders should increase, whether or not the company makes a dividend payment this year. That is why they say that dividend policy or dividend payout patterns are really irrelevant as long as the money is utilized in positive NPV projects. But that's not a very practical argument, because you never know how these projects will turn out to be. Then, of course, you have to consider the cash needs of the entity. Now, we saw earlier that the investment, financing and dividend decisions are all interlinked. Therefore, it is important to also consider the impact of investment and financing when considering dividend policy. Different types of business will have very different cash needs and will therefore have to set their dividend, investment and financing policy accordingly. For example, a small or a company with a poor credit rating will often struggle to raise finance from external sources. So its cash needs might have to be met by restricting the amount of dividends it pays out. Meanwhile, a growing company will have many potential investment opportunities, and the cash needs for these new investments will have to be met by balancing dividend policy alongside external financial sources. So the cash needs of the entity also have to be taken into consideration before you determine dividend policy. And finally, the signaling effect is also very commonly tested as well, right? One area that you get to write a lot on as far as the dividend decision is concerned. Now, investors read signals into the company's dividend decision, and that these signals say as much about the company's future performance as they say about its past performance. So yes, looking at the dividends You can get a read on how the company has done in the past year and over the past 3 years or whatever, but you can also use it as a signal to how the company is going to perform or is likely to perform in the next or in the near future. Thus, management will not necessarily reduce the dividend per share just because last year's performance was poor if they believe the next year performance will be good. If this analysis is correct and investors do indeed read signals into the dividend decision, then the dividend decision becomes important. It becomes important for the company not to give the wrong signal. This is one reason why earnings calls are very aggressively pursued by investors, and within the earnings calls, the DPS figure, right, the dividend per share figure, is also a number that everybody is always paying attention to because of the signaling effect it has. And those are some of the key arguments, well, actually all the key arguments from a theoretical perspective that you have to understand and you have to keep in mind when it comes to determining and evaluating and really thinking about dividend policy. And that brings me to the evaluation aspect. Now, given these contrasting views, how are financial managers to decide on the dividend policy that they should pursue? The answer is that in the real world, like so much else in corporate finance, managers have to make a judgment after taking many varying factors into account. Now, in this process, they will consider things like what dividends are the shareholders expecting, like the clientele effect. What are the cash needs of the company? What dividends did the company pay last year? Consider the signal. They will also take into account a range of other factors, which is what I wanted to get into. Is it legal to pay out a dividend? Is the cash available to pay out a dividend? Do we have a minimum gearing ratio imposed on the company as a financial covenant in a debt agreement that if we pay out dividends will get affected? What is the tax impact for shareholders for paying dividends? What investment opportunities do the company face? How difficult and expensive is it to raise external finance? What has been the rate of inflation? What has been the capital gain or loss in the share price over the last year? Right? These are all other factors that you have to think about, you have to consider when you are establishing and evaluating a preconceived dividend policy before you put it in place. Let's take a look at I would say 4, but we classify them into about 5 dividend policies that a company can follow. Number 1 is stable dividend policy. Paying a constant or constantly growing dividend in each year. This is what a stable policy means, right? You can see how consistency is being pursued in this policy. It offers investors a predictable cash flow, reduces management opportunities to divert funds to non-profitable activities. It works well for mature firms with stable cash flows. However, there is a risk that reduced earnings would force a dividend cut with all the associated difficulties. That is the first one. Number 2 is a constant payout ratio. Now, I want you to pay very careful attention here. These two are very different, right? In stable policy, you're paying a constant or a constantly growing dividend. So the absolute amount is what is constant, right? Either the absolute amount you're paying 5 million every year, or you're paying starting 5 million this year, and you're increasing it at a constant rate of 2% every year, and that is what the investors rely on. But constant payout is a different constancy. It is where you're paying out a constant proportion. So you're saying, out of my whatever earnings I make, whether I make 1 million or whether I make 200 million, I will pay out a constant proportion. I will pay out 5%. That also gives a certain amount of gives certainty to investors, because they know, okay, whatever they make, they'll pay 5%. It maintains a link between earnings reinvestment rate and dividend flow, but the cash flow is unpredictable for the investor, right? The absolute amount is unpredictable. Right? You only know for sure what the ratio is. It gives no indication of management intention or expectation. That leads me to number 3, the zero dividend policy. All surplus earnings are invested back into the business. Such a policy is common during the growth phase, so no dividends, right? Such a policy is common during the growth phase. It should be reflected in increased share price, and it works well for mature firms with stable cash flows. This is what zero dividend policy is. When growth opportunities are exhausted, this is another instance is that, right? That you don't pay out dividends because you have other things to do with it. But once you hit a point where there are no more opportunities and there are no further positive NPV projects, cash will start to accumulate and a new policy will be required. So you'll have to move from a zero dividend policy to something different. That brings me to the fourth one, residual dividend policy. So we looked at stable policy, constant payout ratio, zero dividend policy, and now the residual dividend policy. A dividend is paid only if no further positive NPV projects are available. This may be popular for firms in the growth phase without easy access to alternative sources of funds, right? So if the cash needs are dire and you can't really access other sources of finance, or if you have multiple projects but you invest and then whatever is left, whatever is the residual amount is what you pay as dividends. However, again, this is a policy where the cash flow is unpredictable for the investor, and it also leads to constantly changing signals regarding management expectations, which can be good, but again, the clientele who are attracted to this kind of policy are different, right? They are high risk investors. They have their own set of behaviors that I analyzed even in a P3 context. And that brings me to this is not really essentially a policy in itself, but a way of paying out dividends that ensures that covers a lot of grounds in terms of stability for the investor and also safety for the company. Most firms adopt a variant on the stable dividend policy, a ratchet pattern of payments. This involves paying out a stable but rising DPS. So it's stable and the DPS is increasing also, which is not bad. Dividends lag behind earnings, but then can be maintained even when earnings fall below the dividend level. It avoids bad news signals and it does not disturb the tax position of investors. This is what a ratchet pattern, or this is how a ratchet pattern behaves. So as you can see, this line is the dividend pattern, dividend payout pattern, and one thing that you notice is that it has been continuously growing despite your earnings having very high levels of fluctuation. And even during this phase where a major industrial dispute caused a sudden dip, even less than DPS, since you have maintained excess earnings here, you can afford to maintain a stable dividend. So it is a variant of the stable dividend policy. The investors are happy. Whatever happens, you're safe. The company can afford to pay dividends during tough times, while the growth is looked at from a signaling perspective. The growth is looked at as a positive thing, and therefore investors are attracted. Many investors, institutional investors who like stable returns, prefer this. And that leads me to a few other alternative perspectives to dividend policy. One is this idea of scrip dividends. A scrip dividend or a bonus issue is where shareholders are offered bonus shares free of charge as an alternative to a cash dividend, right? So a bonus share issue completely free of charge as an alternative to a cash dividend. They are useful where the company wishes to retain cash in the business. So you want to keep the money. There's another way to reward your shareholders, right, by issuing these shares. Or where shareholders wish to reinvest dividends in the company but avoid brokerage costs of buying the shares, right? So shareholders don't really want the money at this point. They would rather prefer to avoid the brokerage fees where you take the money where brokerage fees is involved and then pay it back. Let's not do that. You continue to reinvest, right, without going through that entire cycle. There may also be tax advantages of receiving shares rather than cash in some jurisdictions. So that is definitely a possibility. If all shareholders opt for bonus shares, the scrip issue has the effect of capitalizing reserves, and reserves reduce and share capitals increase. The disadvantage to shareholders is that unlike reserves, share capital is non-distributable in the future, right? So it's not an asset in the most liquid form. There can be challenges in converting it into liquidity in case the need arises, and it's not also the easiest to distribute and trade. In addition, both share price and the earnings per share (EPS) are likely to fall due to the greater number of shares in issue, although the overall value of each shareholder's shares and share in future earnings should theoretically remain unchanged, right? So these are the implications to scrip dividends, and however, it has the important advantage to the issuer of retaining cash in the business, right? So the company actually retains the money within the business while still achieving a distribution of reserves in the form of scrip issue. That is one alternative to paying out dividends or dividend policy. You can also go to a share repurchase agreement. Right, let me go back and give you a full view of this. There we go. And then moving forward, share repurchases is a very common and very famously adopted mode of distribution of additional funds to investors in recent times. If you look at 2019 has been by far the biggest year in terms of share repurchases that have happened by companies. A share repurchase can be used to return surplus cash to shareholders. It tends to be used when the company has no positive NPV projects to invest the cash in. So it returns the cash to shareholders so that they can make better use of it rather than it sitting idle in cash investments in the company. I have actually some great information on share repurchases that I will share in the form of videos, additional videos in the shared folder. Alternatively, a share repurchase can be used to privatize a company by buying back a listed company shares from a wide pool of investors. However, this is rare. While we assume that this is rare, this has been happening a lot recently, right, where the company has been buying back ownership from, well, not really the major investors, but the medium, right, the common investor, right, is being bought back even at times by paying premiums. A share repurchase has the following advantages. One is that investors can choose whether or not to sell their shares back. So the investor actually has the option, even though companies make it very difficult by the amount they pitch. They may prefer to keep the shares if they feel that future returns will be high. And it also avoids the risk of a false dividend signal. Now, after a one-off large dividend, the shareholders may be disappointed when the higher level of dividend is not maintained in the future, right? So there is this idea of a one-off large dividend, which we will look at, but that is avoided where the signaling is positive because the company is just buying back ownership, and when you buy back ownership, some of the owners lose ownership, right? So their interest in the company is lost, their connection to the company is lost, whereas the rest of the shareholders, possibly the majority shareholders, are actually very happy that the company is doing so well, right? And it is considered to be a positive signal as well, that the company has so much excess money, and therefore we can trust them, and therefore we can give them money if they need it. And that leads me to the one-off large dividend option. As an alternative to a share repurchase, a company may decide to use a one-off large dividend to return surplus cash to shareholders. Now here you will notice that unlike a share repurchase, ownership is not touched. If all shareholders agree to the repurchase, both a share repurchase and a one-off large dividend have the same impact on the cash and the gearing of the company, where the value of equity is reduced, so the gearing is increased, and therefore financial risk and cost of equity. Although the impact on shareholder value is the same for any individual shareholder, the impact on the price per share will differ with this signal. A dividend results in a lower share price as the number of shares remains the same, but a share repurchase is unlikely to affect the individual share price, but only the number of shares in issue, right? So a one-off large dividend can affect the share price, where the number of shares stay static, but a share repurchase will reduce the number of shares while the share price is, well, attempted to be kept intact. And that says that the one-off large dividend has the advantages of certainty of an ultimate payout, and therefore in looking at these three options, right, so if you are thinking about dividend policy, think of it in general terms. If you are thinking of dividend policy, you have the four key patterns, right? You have the stable payout, the constant payout ratio, You have the zero dividend policy and the residual dividend policy, and a variant of the stable policy is the ratchet pattern that you can maintain. But if you are not considering paying dividends in that form, you obviously have the option to either go for a scrip issue or a one-off large dividend or a share repurchase model. And these all have to be looked at in determining dividend policy, and as you do that, you have to look at all those different arguments, how it will signal, the signaling effect, the clientele effect, the cash needs of the entity, the bird in the hand argument, whether MM's dividend irrelevancy theory is actually true. All these aspects can be considered when you are determining dividend policy. That brings me to the end of this segment. As I always say, keep working while having fun. I hope you enjoyed that session and I hope you learnt a lot. Well, we discussed everything, anything and everything that you are supposed to know as far as dividend policy is concerned. And that is the end of segment 3. Thank you.